from webinar here. This webinar will be recorded and made available on our website following the event. The PowerPoint slides are also posted at this address, www.gfcpa.com/webinars. Participants seeking CPE credit for this presentation must complete and submit a short evaluation survey. It will appear automatically immediately following the webinar. Please use the CPE words as they are given. They will not be provided again. To recall these words in order to receive credit. If an active pop-up blocker, please take a minute now to disable it so it will not block the survey. Technical questions about the survey may be addressed to me after as noted here. As advised, today's learning objective is to provide attendees with a better understanding of employee benefit plans. One CPE credit is available to attendees of today's webinar. So, our speakers, Jackie Gelman, CPA, is Managing Director of Gelman, Rosenberg Freedman. She leads the firm's employee benefit plan audit practice, including audits of 401k, 401a, 403b, profit sharing, pension, and health and welfare plans. She's also a member of the AICPA Employee Benefit Plan Audit Quality Control Center. Jennifer PA is a partner at Gelman, Rosenberg Freedman. In addition to her role as an auditor, she is also a leader in the firm's employee benefit plan audit practice, ensuring clients' compliance with all the specifics of various plan qualifications. With that, I'd like to turn the agenda over to Jennifer Arminger.
Jennifer Disherin, and good morning, everyone. Thanks for joining us today. As Jen Disherin explained, we will be talking about employee benefit plans, and specifically, we're going to take the opportunity to discuss three topics affecting retirement plans and the industry. So, on our agenda, we're first going to take a look at the tax reform and the Tax Act, and which will review the changes that actually occurred out of that new legislation. There's not too many, but we thought it was important to address, especially since it's been a hot topic over the past several months. Secondly, we will take a look at some of the proposed changes out there for retirement plans, specifically some with respect to audits and how those will change, as well as the Form 5500. On our agenda, Jackie is going to walk us through some of the more common mistakes that we see as part of the audit process, giving you all the ability to know really what the DOL is looking for, what we're looking for, to make sure that you and your plan is in compliance with the terms and regulations, and just have a general understanding of what we're seeing are some of the more common errors. So Jen is going to flip the slide, but before we dive into the reform, we're going to go ahead and take a quick survey of who is in our audience. We'd like to get a sense out there of whether or not most of you are currently subject to a plan audit, or maybe you're not subject to an audit now, but expect to be in the near future. We can take a poll of who is participating in the plan audit. So if we take a minute to answer the question, and the results should pop up momentarily. First topic which is a new tax reform and the Tax Act that was finally passed at the nth hour back in December 2017. So it's been a couple months now, and we've certainly got some questions regarding the impacts on our nonprofit practice side, but we wanted to address and vid exactly what resulted from that legislation on the employee benefit plan side. Actually, since during the process of the reform and some of the initial proposed drafts of the legislation did include two big topics that would have affected the industry. And so the first topic that was widely discussed during that early part of the legislation was the potential cap on the contributions of those pre-tax contributions to a retirement plan. And what's being discussed was that the limit would be lowered to about 2,400, and that was the number that was previously included. A big decrease from what we have at the 18,000 limit now. And so the thought being that this would ultimately generate more taxable income, which was ultimately the end goal, and what we see the theme as far as a couple of the proposed items with respect to the retirement plans. And on that very topic, the second item that was first proposed was this concept of Rothification, which is a great word. I enjoy the word, but it was basically as the describing what was the process of transitioning a traditional retirement plan, so pre-tax contributions being put into the plan, to a Roth plan, which was after-tax contributions being put into the plan. So again, on that theme of that this transitioning those traditional plans would ultimately create a taxable revenue stream from those employees' incomes. And so while both of those were put into first drafts of the legislation, luckily they both did not make it into the final bill, but were widely discussed and publicized. And nonetheless, ultimately just gives us a sense of some changes that could always come back in future tax reform legislations. So never know. A substantive change that did come out of the Tax Act for retirement plans is with respect to plan loans. So if our plan allows employees to take loans against the balances of their account, and ultimately the plan, or previously the rule, was that if an employee terminates with the organization and has an outstanding plan loan, they have 60 days to repay that loan, or the remaining balances ultimately reduced from the rest of their investment plan balance. Now, the new rule is that plan participants will have extra time to repay that loan. And they felt it was too difficult for people, especially middle class, to come up with that sort of money in the 2 months. And so what they did was extended that deadline to now employees who terminate would have until the deadline for filing their personal income tax return. So, for example, if you terminated with your employer in May of 2018, let's say, and you had an outstanding loan, you'll actually have until April 15th of the following year, 2019, to be able to repay that back. And so they really aimed at making it more accessible and employees and everyone to come up with the money to repay that loan. small change that I just wanted to mention that came out of the reform was with respect to IRAs, and the rule says that in the instance you had a traditional IRA and you converted it to a Roth, which you can do, under the new rules, you can't convert it back to a traditional IRA, whereas previously this was an option. So that's on the personal retirement plan side, but we did want to mention it because it ultimately was passed within final legislation. So I'm going to be moving into the upcoming changes that are on the audit side, the proposed audit changes, as well as the proposed changes on the tax side for retirement plans, the 5,500. So we want to see how many are currently opting for what's called a limited scope audit versus what's referred to as a full scope audit. So again, we're just going to give you a minute to answer the question. And while we're waiting, I did want to go ahead and give everyone the first CPE word. So please make sure to write down the 3 CPE words to get credit today. And the first one is employee. To our next topic, which is to go through the proposed changes out there for retirement plan audits. And as we kind of teed off, more specifically with the audits that are limited in scope, and we'll visit the 5,500 changes. And so right now there is an exposure draft out there for a new accounting standard called Forming Opinion and Reporting on Financial Statements of Employee Benefit Plans Subject to ERISA. Okay, so definitely a mouthful. What you need to know is that it's ultimately a new accounting standard for limited scope audits and how those would work. And the draft was actually created and proposed in response to results of a survey and findings from a study that took place back in 2015. And we'll take a look at that, what results were in just a minute. But the new standard would actually go into effect at the end of this year, at the end of this plan year, if you're on a calendar year basis. So for fiscal years ending on or after December 15th, 2018. So basically your December 31st, 2018 audits, which are conducted and filed in 2019 by that July 31st, 2019 date. Years ago, the chief accountant of the DL asked the Auditing Standards Board to take a look at the quality of retirement plan audits. And this has been done in several years, and with a number of changes in the industry, with the 403B plans coming under the ERISA umbrella back in 2009, and the changes in just general types of investments being offered, and the market fluctuations and the vehicles that employers are offering to their employees to invest in. It was really time to take a look at how these plans were being audited. And what this study found, published back in May of 2015, is that the employee benefit plan audits, there was almost a 40% deficiency in the 400 plans that were chosen to be reviewed. And so the DOL didn't like this, and there's obviously a need for improvement in the industry and better clarity on what is involved in a limited scope audit. As a result of the study, we've actually seen quite a few more DOL audits of plans, employer plans going into our clients and performing those audits, as well as on our end, just taking a look to ensure that we as a CPA firm, as independent auditors, are performing the work in accordance with the standards. And so we have seen an uptick in that over the past several years as a result of this study. So there are the exposure draft proposes 3 main changes for limited scope audits, but I just first revisit on what it means to have a limited scope versus a full scope audit. And so for retirement plans, ultimately, a full scope audit would be no limitation on the scope of the engagement. We, independent auditors, would issue an audit opinion on the plan financial statements, just as you would for an organization's financial statements, and you receive an opinion. What a limited scope audit, which is acceptable by DOL standards, is that auditors limit the scope of work being done on the investment valuation piece only. And so we could rely on the financial information provided by the custodian or trustees. So if you're with the IAA or Fidelity or another financial institution that provides us with investment-related data and a certification stating that that investment data is complete and accurate to the best of their knowledge, what we would do as auditors is limit our scope of work around that investment. However, that does not exclude the number of other auditing procedures on all the other parts of the plan and the plan document. And so compliance with contributions and distributions and eligibility and vesting. And so there are a number of other procedures that we would need to audit and opine on. But what the study was finding, and where a majority of those deficiencies is where if they ordered that they had the certification, you didn't need to do any other procedures. And so you'll see that these 3 proposed changes really are geared toward making sure that when you're receiving an audit, the opinion and the steps that are being performed really do include the required necessary steps around all those other things, the other things besides the investments. So the very first proposed change is specifically for the audit opinion language, which is confusing in general in the first place. We didn't get asked why we're getting a disclaimer of opinion over over the retirement plan audits, and it has such a negative connotation, the disclaimer of opinion. And so really making sure that everyone understands that, yes, it's a disclaimer, but it really should be called something else. And they picked up on this and they said, okay, let's call it, instead of disclaiming the opinion, let's rework and say it is a limited scope opinion. And what that would do is expand what is included as the basis for the limitation on the scope of the work. It would also put in expanded management responsibilities on how management is responsible for certified information. And that would be included in a special certification paragraph that goes into a lot more detail on, okay, we did receive the certification from TIA or Fidelity, but what does that cover as part of the plan? And in the audit opinion, they are actually proposing to specifically report on any findings in that opinion. And so that would be interesting to see how that would be played out. The exposure draft also includes some additional work on those certifications, as well as, again, going back to that opinion, there would be an additional opinion on compliance with the other terms of the plan document, as well as general terms in compliance with DOL and ERISA regulations. And so they're proposing that the auditor would specifically have to confirm compliance on plan provision A, B, C, or D within that new limited scope opinion. There's some management representations that would be required at the conclusion of the audit. And so these changes are currently in draft form. They're being reviewed. The comment period has closed, so we're really just waiting on the final release of this new auditing standard. But we do anticipate that it will come into play and be released and be effective for next year's audits, or this year that we're currently in for planned fiscal years that are based on the calendar year. And there are also some changes out there proposed to the Form 5500, which have actually been out there for a while. We covered these last year because they were in exposure and proposed draft form last year. Haven't had too much movement because I think the proposed date of implementation is a little longer than the one we currently went over, but nonetheless, they are out there, and we do expect that they are rolled out within the next 2 fiscal periods, and these really address the concepts that we're seeing on the accounting side and tying that into the Form 5500. So you'll see that as we take a look at some of the changes on the 5500, they align to what we just went over on the accounting side, and really overall just a modernization of the form, since again it hasn't been updated or looked at in years, and again it's evolving with the changes in the industry and the fact that now it's much more employment-based retirement, self-contribution retirement plans, shift from what we've seen from the very traditional, almost decades ago, of pension employer-funded retirement plans. And so the general modernization of this form to catch up with those shifts in the industry. And proposed exposure draft is out there with an implementation date of again planners beginning on or after December 15th, 2019. So basically your December 31st, 2019 plan year end. So next plan year, which the audits would be in that 2020 period. And so some of the more high-level proposed changes for the 5500 are overall improvement in the compliance section. So they'll be asking some new questions regarding just general plan operations, the service provider relationship, and financial management of the plan, which we also saw happen on the I-90 side when the IRS added a number of questions in what they considered best practices for an organization. And so you would check yes if you had those best practices, and forcing organizations to ensure that at a minimum they're complying with these best practices. And so this is similar to what had happened on that 990 side, and they'll incorporate similar questions on what they consider as best practice for compliance with financial management of the plan. Just modernization of the investment information. Again, this would address kind of the shift in types of investments that employers are offering within the plan. Enhanced accessibility and usability of the data on the forms. And so this would really, again, modernize and be able to put it in a searchable database, which is not the case right now. And so being able to mine the data from the forms that are being submitted, that's the ultimate goal in improving that piece. Improve certification requirements for limited scope audits. And so there are a number of items within this proposed change that will address what the accounting side is addressing in that limited scope, knowing what management's responsible for, really specifying what that scope is. And so that would be a part in the 5,500. The service provider fee, which is just catching up with the requirements that were released a couple years ago about disclosing the service fees, the plan expense fees, as well as the new fiduciary requirement that we've seen roll out this past year, and just overall ensuring more transparency for fees related to the plan. Report all group health plans covered by Title I of ERISA, which is certainly not the case now. And so, again, just catching up and bringing that form up to speed on the changes that have happened in the industry. All right, so I'm going to hand it over to Jackie in just a minute. But before we do, we have one other question, just getting on whether your audit of the retirement plan has ever resulted with issues or findings. And so taking a moment to answer that. And I can give you our second CPE word, which is retirement. So there's a theme here. Oh, and that haven't resulted in findings, which is great. And hopefully that would be the case. And with that, I am going to hand it off to Jackie.
Jen, everyone, once again. So now we are going to go into common mistakes, and I'll share with you some of the mistakes that we have run into over the years with during the audits of some clients' plans. An important thing to note is mistakes happen. We see it a lot. It's not the end of the world. So if you do have an error, either that employer is the sponsor of the plan that you discover, or it's discovered during a plan audit, know that it can be fixed. It's not the end of the world. So that you'll be fine. We've seen it. We've seen employees through this, and we'll cover some of the ones that we've seen. One of the biggest mistakes and most frequently made common mistakes is untimely employee remittances. Quite a bit. And the important thing to note here is it's the employee contribution that we're referring to. So when we refer to the late remittances, it's the employee's contribution, the deferral, the paycheck. The employer's contribution, if there is one, if you have a match or profit sharing, should follow whatever the plan document stipulates. One of the most common findings, the common misconception is the 15th business day of the subsequent month is what's written in the DO regs. However, it's not a harbor. The DOL wants to be very clear that is not a safe harbor. That is what they call the outside maximum. So you see a lot are employers that assume they have until the 15th business day of the following month to make a contribution. And that includes contributions from the prior month. So for example, if you have two pay periods in the month of April, let's say the 15th and the 30th, and the employees make a deferral. If we're at this, the way some employers do as a safe harbor, they would think that they had until the 15th business day of May to make all of those contributions from both pay periods in April. And that is not the case. So what we've seen as well, employers who remit the employee contributions, but they're not consistent. So they will do them, say, within 2 days, others they'll get in within 10 days. And what the DOL is looking at, they look to your payroll taxes, how quickly you can remit your payroll taxes. And we've actually seen clients that have been audited by the DOL, and they would do, they would come in because the rule is you have to get the funds, the invoices must be put in the participant accounts as soon as they can be reasonably segregated from the funds of the employer. With today's technology and banking and wire transfers, it's pretty easy to do that very quickly. So again, the DOL would look at your payroll tax remittances. How quickly can you get those in? Us can do that within a day. So if the in an audit, and then the first thing they'll do is they'll look at your policies and your procedures to see if you have any, and look at the controls that you have in place. And they what they think that the timeline you should be able to follow. And they look at the trend, and they usually go back 5 years. They see a trend that's in, they will pick a date, consider everything else late. So for example, I had a client that was audited, and they all came in, and they were making their contributions generally within 5 to 10 days. And DOL said, okay, bank controls you have in place, we feel you can get your contributions completed within 5 days every time. Said, we have a policy of 7 days, and this particular client did have a policy of 7 days. We're going to consider, and that's not consistently following the policy. So they said, we're going to consider everything beyond 7 days late, and they go back and fine you, and you will incur penalties and lost earnings for those late remittances for those employees. So they're going to look at the early date of able to get your remittances in, and it's reasonable. And if you don't have a policy, they're going to recommend a policy for you. The best thing that you can do is determine how quick you think you can make those remittances of the employee contributions, form it in policy, and follow it. And you do want to do it as soon as you're able to, because what the DOL is looking at, these are employee funds, and they take this very seriously. This is one of the most common findings that employers get penalized for. They take it seriously because it's employee money, and they feel like if the employer is holding on to that money and not remitting it into the participant account, it's basically a loan to the employer, and that's a prohibited transaction under the regs, because the employer is taking a loan from the employee, from a plan participant. So that's something that you do want to look very carefully at. Look at the 15th business day of the subsequent month. That's the absolute outside maximum. Not well hasn't changed the wording on that, but I can tell you if they were to come in and audit, they're going to look at the earliest date trend and see how early you're able to get your remittances in. And if you do have late remittances, they should be reported. If you have an audit, they should be reported in the schedule that accompanies the financial statements. It's the schedule of delinquent participant contributions. And again, it's not the end of the world. We've seen this. It is a mistake. It can be did, and you can either self-correct it, or you can utilize your plan administrator, or you can go through the correction, voluntary plan correction program that's on the website. So if you go Google ERISA, DOL, or the Employee Benefit Security Administration, if on their website, there's actually steps. They list out the most common plan non-compliance issues and the corrective actions for those. does is that assists you because it basically stops the clock. You pay a reduced fine, and also have a calculator that you can use to calculate lost earnings for the employees, because what you need to do is make your employees whole. So the next common mistake that we see is definition of plan compensation. Plan compensation, we see a lot where employers just assume it's double wages for the definition. It's specifically, you have to understand what it specifically includes or excludes, and there's certain benefits that can be excluded or included, and it's different for each plan. And for example, we had an instance where we had an employer that was reimbursing employees for cell phone usage, and that was being included in their compensation. It being included for deferral calculation purposes, and that was incorrect. So when we went back to the plan document, looked at the plan document, we noted that those employee reimbursements were not included within the definition of compensation. Actually had to go correct, and there's various ways of correcting. You can either retroactively restate your plan, and when you come across something like this where there's we call this an operational error, where you're operating your plan not in compliance with what the plan document indicates, we always recommend getting an ERISA attorney to assist, and they can do that for you. And you can proactively restate the plan, or you can make all of the other employees whole. We would apply the same rule that you've been using for compensation to all of the employees, and it may require a true-up in contribution to certain employees. So you do have options there, but again, there is a way to correct it. So look at your plan's definition of compensation. Look at your plan document. Make sure that you're calculating the deferrals and the employer match or contribution based on what your definition of plan compensation is. I've also seen where some plans include vacation accrual payouts or include them. And I've seen an instance where an employer erroneously was calculating it wrong. They were erroneously including the vacation accrual payouts when they weren't supposed to. The plan document indicated that was not, in fact, included in their definition of compensation. In this case, the employer elected to go back and retroactively restate the plan document to correct that error. And we see non-compliance with the plan document. And the situation I just discussed is one example. It is important to follow your plan document. It serves as a basis for determining your clients, your policies, your processes, loans, vesting provisions, things like that. When we audit it, we audit to the plan document. Now, that said, we also make sure your plan document is up to date for the latest regulations and laws. So you do have to ensure that that is the case as well, that you are, in fact, operating from a up-to-date document. Most plans we see use what's called a prototype document or a volume submitter. And those are the documents. It's essentially a template that you adopt from a plan administrator, from a third administrator, or the custodian if you have a bundled arrangement. And they basically give you an agreement with different options on it. It's already been approved by the IRS, so you can go pick and choose various options within an approved template. And always sure that you have the actual plan document and signed adoption agreement, because technically you have an adoption agreement that isn't signed, and that's another issue we've seen. We'll come in to do an audit, and we ask for the plan document and the adoption agreement, and sometimes they'd have one or the other, or they'll give us an adoption agreement that was never actually signed and dated. So in theory, that means you don't have a plan document, a legal document. So you want to make sure that's signed and dated. And your plan administrator should be regularly amending it to apply with ERISA and the IRS laws. And your plan needs to be restated every 5 to 6 years, depending on what cycle you're on. So you can the plan, and then every 5 to 6 years, depending on your cycle and what type of plan you have, it should be entirely restated. So always make sure that you are keeping your plan document up to date. We call it a scratch plan. There's very few of those, but we do see them. That's where an employer goes to an ERISA attorney and has them design a plan specifically for them, and it needs to be submitted for approval of the IRS and on a different restatement cycle. But it's this issue where you are responsible for ensuring that it is up to date and amended and restated regularly. So, and have an updated plan document. And again, if you don't, and there's an issue there, we call that a form non-compliance, where your plan document is in error somehow. That too can be corrected. Again, we refer to ERISA attorneys to assist with that because it does require some legal expertise that's out of the scope of what the auditors can provide, but it's able to be corrected. We've seen that happen. You can correct it and move forward. Again, we will audit to the plan document, assuming that's up to date, and we just want to make sure that you follow your plan document. We've also seen instances where employers were providing too many loans to an employee. Their plan allowed 2 loans. The employee had 3, and they were rolling 2-year period on your loans. We've seen where vesting provisions weren't appropriately provided. We've also seen errors in the calculation of employer contributions, the matches, and the profit sharing. So these are just various different things that we see where there's a non-compliance with the plan document. So you want to make sure that you're following that document and following it consistently for all employees across the board. And the thing you want to make sure of too is that your system, that you're taking all changes in employee deferrals. Most employees go online now with the plan custodian to make those changes, and those filter down through to your payroll, whoever your payroll. And you want to make sure those changes are made and the employees are getting their contributions calculated correctly and remitted correctly. And make sure there are controls in place to catch an error should one occur. We have seen that happen where an employee's their deferral wasn't calculated correctly, or for whatever reason it wasn't, didn't sign a waiver that they didn't want to participate, and their contributions weren't being made. Again, it can be corrected, but you try and head off at the pass and have controls that will catch that type of thing when it occurs. Another common mistake we see a lot is failing to get an audit when it's required. So the general rule is that audits are required for plans with 100 or more participants. And it's careful, you have to be careful to understand the definition of participant. A participant includes all eligible employees, whether or not they're participating. So if you have employees who are eligible but have elected not to participate, they still count as a plan participant. Also, all pre-employed participants who still have account balances. So if you have an old plan, and we mean this, where an employer has a really old plan and they have a very small number of employees, they're always sort of perplexed at why they need an audit, and then they discover that they have all of these terminated employees that have balances in their accounts. They count as participants. So there are rules about the threshold, which we want you to look at with your plan administrator when you adopt your plan document, to look threshold. And we've we recommended to clients and had them change their threshold so that you can basically kick out participants if their balance is under a certain dollar amount. You're not increasing your administrative expenses of your plan and required to have an audit for every terminated employee, if they have like $100 balance in the plan. And again, world, again, we've seen instances where we've had a client come forward and say, we think we were required to have an audit. We had a participant count wrong. We filed a 5,500 for a small plan without it. What do we do? This can be corrected, and usually it's you go through the correction program, the voluntary correction program on the EBSA website. And if you're late in filing a 5,500, they also have a delinquent filer program as well, which we can offer some assistance there and guidance in terms of how to do that. But there's a way to correct it. And they're the other common mistakes is that someone files a 5500 late, or they file an audit and find out later that they were required to have an audit. The 8120 rule is intended to allow employers who hover right around that 100 number to get the audit requirement if they frequently fluctuate just above and just below 100, because they don't want to put this, on the employer. They understand it's expensive, it's an administrative burden. So if you're a small employer and you have 100 employees, and then 1 year you're up to 102, and then the next year you're down to 90, so you need an audit, then you don't need an audit. What this rule is intended to do is give you some relief there. So if you have, say, 95 participants, next year, notice that you have 115. You had 95. You were considered a small plan. You filed as a small plan, filed the short form 5500. The 820 rule says you can elect, if you have less than 120 participants, to look to the prior year and elect to file the same way you did in the prior year. So in this instance, let's under year ending 12/31/17, and I had 115 participants. But in calendar year 2016, plan year 2016, I had 95. I'm to elect the same way I did in 2016 as a small plan. I don't need an audit. Continue to do that until you exceed the 120, at which point you have to go back under 100 again to be able to take advantage of that rule again. It's also very important to note that the count takes place at the beginning of the year, at the very first day of your plan year. So if you're a calendar year plan, it's January 1. It's not the end of the year. It's as of January 1, what is your participant count? So if I'm going to look at my participant count for my 2017 year to see if I need an audit, I'm looking at January 1, 2017 to determine if my year ending 12/31/17 needs an audit. Again, there's ways to correct. There are some penalties and fees involved. Get it taken care of right away, and you take advantage of the voluntary compliance program. Those fees are greatly reduced. And we encourage, anyone to come forward if they need help. Again, errors happen. It's not a big deal. The DOL wants to help employers run these plans in a fail-safe way. They don't want to do it. It's not a gotcha. They're not trying to, get people in trouble and make all of our lives very difficult. They just want to ensure that the employers are being treated fairly and that the employers are taking their plans seriously and following the rules. They came up with a voluntary compliance program as a measure to say, look, we know mistakes happen. We're going to help you. We'll reduce your fines and penalties if you just come forward and say we made a mistake and let's fix it and move on. With that, I'm going to give the very last CPE word, which is plan. So a CPE word is plan. And now we have about 15 minutes left. We're going to take some questions from our audience.
During the course of the webinar, we've received a number of questions. So I'm going to read off some of those for the two ladies to answer for you. First one, how will we know when we are required to audit of our employee benefit plan? That's a good question.
Take that. That's it's covered, but just to reiterate, you need an audit if you're over 100 participants as of the beginning of your plan year. And the participant definition does include employees who still have account balances, as well as eligible employees who are not participating.
That's the one that always holds a lot of organizations up, Jackie, is that participant thing too, and then the terminated balances that remain sitting there for employees who haven't worked at the organization for years. And so while I might only have 20 employees on staff, you would potentially still have over 100 balances and have to require a plan audit. So that comes up quite often.
That's a question.
Absolutely. So I think a bit of clarification. I think someone who maybe didn't hear this before. Arminger, did you say the legislation for sure passed and is not effective until 2019?
The tax reform legislation is effective now. So that was passed in December 17 and is effective in the year that we're in. And so that relates to the change in the plan loans and the IRA thing. The next new proposed standard is the one on the audits and the limited scopes, and that's going to be effective for this year, so December 31st, 2018, and then the next one is the changes on the 5500, which would be effective in 19. So tax reform now, the standards for limited scope audits, which is still pending, but we anticipate as of the end of this year. Then again, the next one, the 5500, still pending, but we anticipate at the end of 19. So that's good. Thanks for clarifying that.
Okay. We have some other questions. Audit, will we have to do one each year? And is there any way to get around this requirement?
I'll take that one. If you have an audit, you don't necessarily have to have one each year. If you're fortunate enough to take advantage of the 8120 rule, you can often get audit requirements exceed the 120 participants. If you exceed the 120 and you have an audit, it doesn't necessarily mean that you'll need one the following year, because we have seen employers that have had a change in circumstances where, for whatever reason, they ended up with significantly less participants, so they had an audit in one year and then they went under 100. They didn't need an audit the following year. But really, to get out of the audit requirement is to be under the participant threshold. And 403B plans do have some relief, and this is where we like to get the ERISA attorneys involved, because of the definition of contracts, and certain insurance contracts fall under the relief that was offered previously in 2009 when the 403B regs first started requiring audits of 403B plans. And there are certain participant accounts and certain contracts with insurance companies that are considered not part of plan assets. So we've seen some of our 403B plans, they're able to out of the audit requirement because some of those assets are deemed to be contracts directly with participants and not part of plan assets. Therefore, they did not go into the participant count. But that's not like a dirty answer. That requires a very careful look, and usually the involvement of certainly the plan administrator who maintains those records, as well as potentially an ERISA attorney.
I think you mentioned earlier where our participants could find a template of the compensation plan for someone who's just maybe doing a plan this year.
Compensation plan. What referring to is the fact that you could adopt a plan document from a plan administrator, and it will give you options of compensation, among other things. And it's basically a template for a plan document that's provided, like, say, for example, if your plan administrator is ADP, or you have a bundled arrangement with Fidelity, they have prototypes or volume submitter documents, which we refer to as a template, that you can use, and they give you an adoption agreement, and they give you various different options to choose. You must adopt that agreement from them and have a signed adoption agreement. But it does give you a template. First, you need to decide on the provider that you're going to go with and see it offer, in fact, a prototype plan for you to use.
Great. Okay. Question here. Our employee contributions are made on the 7th day after the pay date. This consistent process that we have used for many years and not raised an issue under an audit. Is the timing considered reasonable?
I can that, Jackie, if you want. And I know you had mentioned this a lot on the where we find some most common errors is with that timely remittance of the employee contributions. And again, I think he was stressing and reiterating is consistency. So if, for example, every pay period you are consistently remitting within 7 days after the pay date, you are ultimately setting your standard. You have set the standard that is what you all can remit in a timely manner. Now, some organizations might be able to do it in 2 days, and they consistently show that they can do it in 2 days. And so if they had all of their pay periods in 2 days and then one in 7 days, that one might be deemed late for that specific plan because they have set a different standard than you have. And so as long as you are demonstrating that it is consistent and that it is done in a timely manner, then yes, I think that the 7th day would be reasonable, but it goes back to consistency.
Okay.
I also mentioned real quickly that the DOL did state that 3B plans had small plans. It indicated that the small filers under 100 participants had 7 days of safe harbor, but they did not allow that same safe harbor for the large plans. So whatever it's worth, we see the 7 days a lot, but we want to make sure that employees understand that it's not a safe harbor for all plans. It is based on your particular system, and for those 7 days, the employer that is following the 7 days consistently, I would document that. Make sure you have a policy that's the policy you're following. And in the unlikely event that you were to get an audit, I would be prepared to defend that 7 days.
Yeah, they really look towards when you can remit the payroll taxes, and if that's being done earlier. And other withholdings, then again, you would have to just justify that with documentation.
Okay. Time for one more quick question. This one kind of looks toward the future. When is the Department of Labor planning to perform their next study on employee benefit plans?
That one. We don't know for sure, but it seems to be that they're doing it pretty regularly. And as auditors, we're told to be on the lookout for the DOL doing studies and coming in to audit our work. So they're very much interested in plans and ensuring that they are maintained compliance with if they're an ERISA plan. So we don't know for sure when the next study is, but I'm sure it's probably going to be fairly recent.
Okay.
I'm going to address one more question real quick. I think I saw a question that popped up about a safe harbor. A couple of questions about a safe harbor. One says, how about for the 401k? There was never a safe harbor rule for 401ks. Simply something that was DOL's way of being generous, so to speak, and flexible when 403B regs came into being, because that kind of shocked a lot of 403B plan sponsors. So that was a way of sort of softening the blow a little bit to say, okay, if you're a small plan, we'll give you guys time to kind of catch up since you've not been subjected to these same rules. So that safe harbor applied to 403B plans only, the small plans. I think I saw another question about adopting a safe harbor provision, which is a separate safe harbor. And we were talking about contributions, the contribution structure to your plan. That's not a quick answer, but what I would encourage you to do is talk with your plan administrator or your custodian, whomever you're adopting that plan from. And you just want to look carefully at the costs versus the benefit. Safe harbors can be wonderful. What they are designed to do is to alleviate the non-discrimination testing and the top-heavy issues that plans have. So you automatically pass these non-discrimination tests, but that does come at a price. So you see employers who have them and employers who have opted not to adopt the safe harbors because find that it's too expensive. It requires you to basically contribute a certain percentage across the board to all employees. So it's worth looking at. We have them in their plans, but you want to look at that, at what it will cost you in additional contributions and expense versus, what the risk of you failing your discrimination testing.
Jackie, with that, we'll wrap up today's webinar. I want to invite everyone to join us again next month. We're having a webinar on a presentation of financial statements on May 31st, again, 11 to 12, and you can register at the address noted here. So if you have additional questions, please do reach out. You can reach Jackie and Jennifer at the info noted here. I also want to just point out that as you close out of the webinar, you will receive a survey. It will pop up. Hope you've disabled your pop-up blocker. I'll ask you for those 3 CPE questions. If you could have those, the survey, and send those to us, we'll make sure that you get a CPE certificate. Again, joining us, and please have a day.
Thanks for participating.